What's happening, investors? It is February 6th. It's the video like it takes 30,000 to a million. It's going to happen, but it's going to happen very, very slowly. This is my account right now. This is an account review, an update on the account. And most importantly, as promised, I have put on the calendar spread. So we're going to check up on that and see how that's doing. I did it early in the morning this morning. I'm filming this really late at night. It's 11. Well, not really late, but late for most people. It's 11:35 p.m. and let's do it. So this is the account. I only have a few options. This is the calendar spread. We'll check it out in a second. It's gained $3, a huge 2.83% gain in one day. But I only have like $100 tied up on it. So these stock positions here, these spreads are irrelevant. They don't have much tied up, and these are my equity positions. So we got Apple, Realty Income, and Main Street Capital. That's it. That's all I'm holding. In addition, I'm also holding $49,538 in cash, sitting in the brokerage account, collecting interest from Robinhood Gold, which is deciding to award me 4.15% on my cash for just sitting there. My trades still haven't cleared, and that is why I haven't gotten paid more for this month. It's only paying interest on about $4,300 worth of cash, but it will pay interest once the rest of the money hits the account. It gets cleared, it gets settled. I will be getting paid more. The way that the brokerage cash sweep works in Robinhood and in other brokerages too is that they pay you once per month. It's like a little bit of a dividend for keeping your cash in there, for letting them sweep it. So you got, the next payday, they tell you where it is, the end of the month, February 28th. And this is how much interest they're going to give me so far. $2.78. Not quite a Starbucks coffee, but we'll get there. Okay, we'll get there. This will quintuple, and then maybe we can buy a Starbucks coffee afterwards. So let's see the performance. One day, 0.71 in the negatives. It was okay. 1 week, up 4.66. 1 month, almost up 20%. 3 months, almost 9%. Year to date, 32% year to date. Holy smokes. We got 1 year flat. And this is the all-time chart. I'm gonna miss seeing these numbers, honestly. Once the cash goes out, it's gonna be totally jumbled up, and it's gonna be hard to measure the progression, like things like year to date, year over year. These numbers are not gonna be as relevant. What's gonna be more relevant is this chart. It's gonna make it's gonna be more realistic, closer to the truth, and then the 1 day, 1 week, etc. charts are gonna be realistic as well. Just to fill you in case you have missed some of the videos, I have decided to take out this money, the 42,000, because if you go to the O chart, you see that it says 72,200. So I'm going to take the $42,200 out, so it's really 30K to a million instead of just like 30K plus adding money in there and then getting to a million. Most of the money was added here in 2021 on the bull side, and since it's come down, I'm probably going to be exiting at about the same time that most of the money entered. But it's just, this number is never going to be realistic since I made the mistake of adding money to the account. I should have just kept it at 30 and just started a separate account for myself, which I do have separate account. I should have just fed the money into a different account instead of the public account. But that's on me. That's my mistake. I'm going to try to stay away from that from now on, and will not be making that mistake again. We'll see what happens in the future. No one knows. The future is very uncertain. So who knows what I decide to do. I mean, I decided to do this now. Maybe I'll change my mind in the future. It's hard to tell. But I'll try to do what's right. We'll see. Okay, so let's go into a little more in depth here. This is the investing tab. We got $180, a little more than $180 27.49% of that is cash. And then options and equity, 72.51%. No margin. There was a time, a long time ago, maybe like a month ago or two, where the entire account was all margined out. I was almost at 100% leverage in December sometime. I made a video about it. If you want to check it out, you can. Scroll back, you'll see it. And December is a pretty dark month for investing if you're in my account, if you're me. But things turned up this January, and I was able to recoup some of my losses, not all my losses, in this bull impulse in January. If I had held on to my guns, I could have actually reached all the way close to my former highs of 214,000, but I did not. I elected to reduce risk because I wanted to exit the money out anyways. So I turned a lot of the positions into cash, like Smith & Wesson, Paramount. These positions are now gone. I still like Smith & Wesson as a company, like I've talked in other videos, but I don't own at the moment. I will be probably looking for a better entry point than this. And I may not actually ever enter it again, depending on what's going on with their cash positions and what the management is deciding to do. And I have to relate that to how overvalued or undervalued the stock is. So there's a lot of things for me to look for in the Smith & Wesson's reports, and for me to decide how to proceed from here. I'm gonna have some cash on the sidelines, waiting to perhaps enter Smith & Wesson, but I mean, this is the time where I really wish I had insider data, right? So I want, because it might be too late to enter after the report. Because if the company goes up like 20% after the report, I'm not entering. If it goes down 20%, it's probably bad news. There is a possibility, though, that other investors are not looking for the same things that I am in the company. So the company might be down 10% or flat, where I see something really positive when it comes to my criterias for owning the company, and it would be a good deal for me. So that could happen. So I'm hoping for that exact scenario, actually. Okay. My positions ranked, it's so silly ranking them now because there's only 3 of them. There was a time, again, in the past, in the not so distant past, where I had like 20 positions in the portfolio. And so ranking them was kind of cool and fun and insightful. And now I've only got 3. It's like having 3 fingers instead of 10. It's really boring just counting the 3. So we got total return, Apple Realty Income, Main Street Capital. I've only have my winning positions left. Sorted by equity, Apple, Main Street Capital, Realty Income. All right. That's not counting the dividends, by the way. Okay, so back to the chart here. Now, year to date, I'm interested in that, but let's take a look because I can't do year to date on the S&P 500. Let's see how the 1 month chart goes on the SPY. So I'm sitting at 19.84. The SPY, what is going on here? Oh, this is the options watch list. Oh my goodness. Okay, so the SPY 1 month chart is at 4.93%, so less than 4 times less, or somewhere about there. That's not bad. It's not bad. And I think my account is probably less volatile than S&P 500 now. I think I have like a 0.9 beta or something like that, which means 1 beta is the volatility of the S&P 500. I think my account at the moment is probably less volatile than that. But we'll see. Maybe it's not in reality. So those are my positions. As far as what's going on in the markets, it seems like from a technical perspective, right, I'm just going to summarize because I'm not a technician and I'm just looking to other people for this kind of insight. But it seems like the technicians, the group, have decided that there's been a decisive breakout out of a downward cone. The cone got filled and the S&P broke to the upside. So all the technicians, if they were to stick to their guns, even if their predisposition is bearish or whatnot, they have to admit that there's going to be a bullish a bullish impulse continuation here at this point. And we don't know how long it's going to last. Some people have used Fibonacci numbers to try to figure out how high, the S&P is going to go. Like, let's go to the SPY again. Let's take a look at a 3-month chart. So right now it's 416. People are predicting that, it's probably going to go to like 430, 440 on the SPY equivalent. Of course, they just look at the S&P 500 index instead of the SPY, but it's virtually the same. So they're predicting basically 4,300, 4,400 on the S&P 500. A lot of hundreds there. And that could still very well happen. It could be smaller, whatever. It could be bigger. So, but according to the technicians, there's still more upside to go. And I'm wondering, how right the technicians will be this time around, or whether this is the end of the rally, whether it's a false breakout or not. There's always these possibilities when you're doing technical analysis that it's going to go against you a certain percentage of the time. And the trouble I have with technical analysis is that we never know what that percentage is. And I keep asking technicians the same exact question. I ask them, okay, I get it. You have a channel, you have a breakout. What is the chance? What is the percentage chance that this breakout is legitimate or a fake breakout? I always wonder. And when they say a percentage, I'm like, okay. Now, could you please, in a non-sarcastic way, I'm not trying to be a dick, how did you arrive at that percentage? Like, do they aggregate, they meaning like technical analysis, dedicated people, did you aggregate all channels of all stocks? Did you aggregate just the S&P 500? What did you use as a sample size? What large was your sample size? Did you do individual stocks only? Did you do a mix of both? Over what time period? Did you go back to the 1900s? Is this like for the last 6 months? Was there a test done like in 2016? How big is that sample? How relevant is that information? Like, what if the stock that you're working with, this particular stock, has a different percentage false breakouts than the overall market that you've studied with, like, trillions of examples, but this stock is individual, so therefore it doesn't apply. Do you see what I'm saying? I don't understand how they derived at these conclusions as to how to measure the percentage of success for each technical pattern resolution. So this is the problem I have with technical analysis. I understand the self-fulfilling prophecy and all that, but like I said, how do you know what the percentage? If people knew exactly, right? If people knew that, okay, it's greater than 50%, then all technical analysts would be like the richest people on earth, right? Let's say there's a 55% success ratio. They would be the richest people. We wouldn't have Warren Buffett. We wouldn't have like Bill Gates or whatever, Mark Zuckerberg or Elon or Bezos. It would be all technical analysts up there. Even the Goldman Sachs of the world, like, they don't use technical analysis. They just buy the market. They just manipulate the market. They're just market makers. They just operate a casino, right? It's not like they're going out there doing market and like chart analysis. Now, I'm not trying to hate on the technicians. Like, I use it to see, like, okay, more likely, less likely, or I'm just curious from like a bystander perspective. I'm curious as to, like, okay, let's see if they're right this time around, right? But I'm just kind of watching it like a derby or something, or like a horse race, without actually betting on the horses, right? I'm just curious because, the only thing that kind of matters to me when it comes to technical analysis is for some industries is, all right, is it down relatively speaking historically, or is it up, and what is the overall trend over a multi-decade period, right? For example, commodities versus dollar. All right, there's a multi-decade period where commodities tend to get cheaper relative to the dollar, and that trend's been in place for many decades. Okay, where are we at right now in the cycle? Are we low or are we high? Is it worth my salt actually investing into commodities at this point? Because of their historical relative valuation. And if the answer is yes, then okay, then maybe I can look for an opportunity to add some silver or some industrial metal, whatever the hell I think is going on from a macroeconomic perspective. But if not, I'll just leave it alone. So this kind of stuff, it matters, but like getting into like starting to draw charts out there and starting to do lines and all that stuff, and trying to do like circles and coffee cups or whatever people doing, like, all right, like if you're having some success, if you're having success with that, and it's making you money, then go for it and do it. Like, I don't have anything against that at all. I might sound bitter. I'm actually not. Like, I want people to make money. I want them to do chart analysis if it's working for them. I just don't understand it personally. I would love to have someone. In fact, if you're an analyst, if you're a chart analyst, I would like to talk to you. You know what? Maybe we can even video it. Like, we can talk over here. We'll do like a little interview. I'm not gonna interrogate you. I'm honestly trying to figure out like how does this even make sense? Where does the predictive power come from in chart analysis? What's even more incredible than this is I don't know how I got onto this rant. I started talking about the account, and I remember I talked about S&P 500, how it's broken out our channel. Okay, so we're expecting some upward momentum here, but we'll see if it materializes or not. But anyways, sorry about the rant. But I do actually want to know people's opinion, what they think about, price analysis from that perspective, from a charting perspective. Whether or not you think it holds merit, and what is the argument for this type of analysis holding merit. I want to know. So let me know in the comments. Also, let me know if you want to talk to me, and we can film it. It'd be fun. All right. With that said, peace out.